My name's Adam Burniston and I'm the lead portfolio manager for the model portfolio service here at LGT Wealth Management. And I'll be talking to you today about how the portfolios are positioned and how they've performed so far this year and also over the last 12 months. The performance of the models has been very pleasing over all time periods. We're back to outperforming the Investment Association mixed asset indexes, which we quite often benchmark ourselves against. The only one slight bit of underperformance, which is very marginal, is from the defensive portfolio, and that's only over the year-to-date timeframe. The reason for this, it's quite emblematic of our risk-first defensive approach to investing. We've got quite high cash weightings, we've got allocations to very safe and defensive investment classes like government bonds and money market funds. When I say we're underperforming, it's by less than 0.1%, so actually we're very much in line in that respect. All the other timeframes and all the other models, we are outperforming over every time frame. The top performing funds year to date and over the last 12 months are the funds that most characterize our investment philosophy, which is of high quality companies that are growing, otherwise known as quality growth. Fundsmith, our top performing fund year to date, ran by the acclaimed Terry Smith, is famous for its high performing, high quality growth investment philosophy that's been going for over a decade. If we just break down what those adjectives mean, growth quite intuitively means the businesses are growing. High quality refers to the quality of the balance sheet, that is low debt or low leverage, and a high return on the assets employed within the company business model. So we're looking for businesses that have got good quality metrics but are still growing in their profitability and revenue. If we come on to the first big headline of 2023, or one of the many headlines we've seen in 2023, that is of the banking crisis. Fortunately for LGT and our investors, typically banks don't meet the high quality criteria that we look for when investing in companies. Therefore, we've had very low allocation to those types of businesses. The banking sector actually got off to a good start to the year, up around 12%, but since then has fallen off dramatically since the Silicon Valley Bank debacle started and took down the rest of the sector with it to quite a high degree. Thankfully, as I say, LGT has very low allocation to banks, and that's not because we think we're cleverer than anyone else or we're predicting a banking crisis. It's more a symptom, and in this case a positive symptom, of the fact that banks very rarely meet the high quality criteria that we want from the companies we invest in, and therefore naturally we had a very low allocation to what we see as typically low quality businesses. As you can see here, compared to our peers in the model portfolio space, we have the lowest allocation to banks in the UK model portfolio market. Similarly, with the commodity sector, again, typically an industry that we deem to be fairly low quality. They've got no price control over what they produce. Regardless of whether you're Shell or BP, if you take a barrel of oil out of the ground, you sell it for the going market rate. We see this as a low quality metric, so we generally have quite a low allocation to commodity businesses. Again, compared to our peers, we have the lowest allocation to these types of businesses. So once again, this has been very constructive to our performance year to date. Thanks very much for listening.